Now let's move on to understand why do we actually require financial statements. Basically, information is required by many groups of people when you are running a business. For example, the managers in the organization itself may want to know from time to time, for example, what is the cash balance, what is the stock that is lying in terms of finished goods, what is the amount due from a particular customer whom you have already sold. So those nature of information is required by the internal people, the managers of the company itself or the business itself, and therefore that for example, the financial statements will be able to give that kind of information. Second are the shareholders or the owners of the business. The owners of the business from time to time would like to know what is the financial status, how the performance of the business is. The third is the trade contacts. Now you are dealing with a number of customers as well as number of suppliers who are supplying you raw material, etc. Now they would like to assess from time to time as to how your business is doing. Can they continue to deal with you? Is the financial position deteriorating, in which means if they enter into a contract with you for supply of certain goods, you are not able to supply, then it will be a problem for them. So the financial status of either a customer or the supplier becomes very important for the trade people, and therefore they would like to keep a tab on what is happening, and that kind of information is required. Lenders, of course, banks, they would like to know how the business is doing, because when they lend to you, they want their money back, and therefore the performance has to be assessed from time to time by lenders so that they can know as to how you're doing and is their money safe with you. Analysts, generally people who tend to either lend or, for example, invest in your company as part owners, might also want to track from time to time as to how you're performing, so that ensuring that their investment in your company is doing well and there is not a major risk to their investment not giving them a decent return. The employees themselves may also want to know from time to time, and this is a major HR exercise or the human resources exercise to ensure that the morale of the employees are kept up, so that from time to time when you actually give them an idea of how the company is performing, they also contribute and feel good about better performances, and if the performances are coming down, then they also start contributing to ensure that the performances can be improved. In general, the position known to the employees, or knowledge of the financial position by the employees, is a good thing also. Apart from that, the government, now the income tax department, you are earning a profit, you also have to pay a tax on it. So that is something that the income tax department would like to know what is happening, how much profit are you making, etc. Not only that, there are other government agencies. As I mentioned, registrar of companies, you need to give them the information from time to time, and there are other agencies like the excise duty related tax payment or sales tax related tax payment, etc., which also require financial information from you. Those companies which are listed on the stock exchanges are public companies, as they are called, and these companies need to also inform the public in general, the investment public as general, as to what they are doing. So there are various purposes for which financial statements are actually drawn, and they are used by various types of users. Now let's move on to look at what are the different types of financial statement. The two major financial statements that we will see are the balance sheet and the profit and loss account. Now what is a balance sheet? Balance sheet basically tells you that at any point in time, what is the business owning in terms of assets, and what does the business owe to various other people outside the business, so they are the liabilities. So essentially it is a summary of assets owned by the business at a particular time and assets, liabilities owed by the business at a particular time. That is why it's called as a financial position or a snapshot of finding out what are the assets that the business owns and what are the liabilities that the business owes at a particular point in time. Remember, this is a very important point that we are saying is at a moment in time, is because one day before or one day after, the position can change. For example, if I own 1 lakh worth of stocks today, tomorrow 10,000 may get sold, therefore my stock position may come to 90,000. Similarly, if I had a borrowing of say 1 lakh yesterday, if I had repaid 10,000 today and I had repaid at 10,000 rupees, then my borrowing will come down by 90,000. So every day the financial position of the company as the transaction happens keep changing. So a balance sheet is always at a particular point in time. On a particular day, it says what are the assets owned and what are the liabilities that the business has, what it owes to the outside people, outside to the business. So that is what is financial position or the balance sheet of a firm or a company is. What are assets? Assets essentially are in the form of factories, office buildings, delivery vans, computers, machinery and so on and so forth. These are the assets that the business is going to use to generate income or sales. Some of these assets have a long term life. The productive life of the assets are long. For example, when you buy a machinery, it could be useful to you over a 5-year period. A computer may be useful to you about 2.5 years. A van may be about 3 to 4 years. So since the usage of that particular asset is for a multiple more than 1 year, they are also termed as fixed assets. So one of the things that we do is whenever we buy a fixed asset, the cost of the fixed asset is not immediately taken out as a expenditure. Why? The simple reason, as I told you, since this asset is going to be used over a 3, 4 or a 5-year period, I would rather have this expenditure which I have incurred today be reckoned or be shown only over this 3 or 4 or 5-year period. Let me give you an example here. Let's say we have a machinery that we have bought for a lakh of rupees and we expect that it can work for me for over a 5-year period. So what does it mean? That I'm going to generate income from this machine over a 5-year period. So it is only prudent or it is only fair that I should not charge the full cost of the machine to my income in the first year itself as an expense. I should take divided probably equally over the 5-year period, charge only 20,000 rupees in the first year of operation and then the balance value I carry forward, and then charge another 20,000 rupees after the second year of operation. Now this is what I will do. So then at the end of first year my value will be 80,000, in the end of second year it will be 60,000 and so on and so forth. So that I am charging, now that is called as depreciation. This act of charging a certain amount on assets that have long term use for you over their useful period is called as depreciation. Then there will be other assets which will be only for short term, which you just buy and trade, you just sell it off. For example, a grocery shop might have various types of groceries like soaps, toothpaste, other consumables, vegetables and all this is not held for a long period of time. It is held for a few days or a weeks or even the same day it can be sold off. Such assets which are in the nature of trade, where you trade in it, where you sell them immediately, are known as current assets. Basically, current assets are those which get converted into a sale over a period of 1 year or so, not more than 1 year. They are called as current assets. In terms of liability, we looked at the asset part of what a business can have. Now we look at the liability part. Liability basically means the business or any individual can owe something to somebody. You have borrowed money, you owe that money back because you have to repay that money. So when a business take bank loans or they take overdraft from banks, they are liabilities of the business. They have an obligation to repay this amount. Similarly, when you buy from your suppliers or vendors, you buy raw materials or other goods, you have a obligation to pay them, and if you are taking money on credit, that is you are going to pay after 30 days or 45 days and you purchase the raw material on that basis, then they are also a liability. That amount is also a liability and you have to pay them. So these kind of liabilities which are to be paid within a short term of about 1 year or so, less than 1 year or so, are called as current liabilities. Then capital or equity, the third part of the balance sheet. So you have the assets, you have the liability. Within the liability there are two parts. One, what you owe to the outside of the business, and then the other part is what the business owns to the owners. So the business from an accounting perspective is looked at as a separate person. The owner is separate, the business is separate, be it a sole proprietor, be it a partnership, be it a limited company. The business is separate from owners from an accounting point of view, from a point of view of looking at money inflow and money outflow which is being recorded in the business. So from that perspective, from a legal perspective, sole proprietors and partnerships are same. There is no difference, the law does not differentiate. But from an accounting perspective, the business is different from its owners. So when an owner brings money into the business, he puts capital into the business, he invests money into the business, then that business in turn owes that money to the owner. So we have the business owing money to the owners, and we have business owing money to the outsiders. So those are called as outside liabilities. This is a liability to the owner of the business. So a typical balance sheet will state how much has the owner brought in, and therefore this is a liability of the business to the owners. In this case, say about 6 lakhs of rupees have been brought in by the owners, and that is a liability of the business. The business is, as I said before, looked at as a separate person. The business and the ownership from an accounting perspective are differentiated. Then what is the outside liability? That is not to the owners, other than the owners, what I have brought in into the business. So business owes 6 lakhs to the owners, and it owes 5 lakhs because it has taken a bank loan, and it owes it to the outsider outside of the business. Now using this money that it has borrowed or it owes, what it has done, it has created these assets. So the assets are mentioned here for you, and you will find that the total of what you have brought in by way of money by incurring a liability, it can be a liability from outside party or from the owners, and that total should normally, if everything is right, match with the total of the assets that the business has. So this is extremely important to understand. We will be re-emphasizing this as we go along in later chapters much more. So basically a balance sheet gives you a snapshot view. As I said, it is a view at a particular time of what the business owes, the liabilities, and what the business owns, the assets. So that is what balance sheet is all about.